you here. We've got a lot to cover in the next hour or so, so I'm not going to take too long on the introduction. I do want to address some questions that came in ahead of this presentation, and also just set some ground rules kind of and guidelines to help you with questions throughout our time together today. Again, I think we have about an hour. I think we're scheduled to conclude about one-ish. So couple things. First of all, as Debbie said, my name is Sandy Horner. I'm with Baltimore-Washington Financial Advisors. We're a registered investment advisory firm based out in Columbia. And as you heard Debbie mention, we've been partnering with the credit union now for 5 or 6 years. We are a fiduciary advisor, so we're not a broker. So we'll talk about this a little bit later, but it's very important that you understand what the differences are between just working with a broker and a fiduciary. It's a very different experience. So we'll talk about that in a little bit. And I really like this presentation. And to be blunt, that's actually kind of saying a lot. And let me qualify what I mean by that. I do about 184 of these types of online webinars every year. And this one especially really covers a broad gamut of information. And so if you're looking at retirement, there's a lot of good information in today's webinar. We're not going to go really, really deep in any one area with a lot of granular details. We can save that for another conversation, but we're going to give an overview of a lot of different areas today. And by the way, we're going to send you a copy of these slides later, so you'll have that. And then I will just let you know up front that we're happy at BWFA to speak with you at any point in time. There's no cost, there's no obligation if you ever want to do that. So today we're going to talk about avoiding the common mistakes. Have you saved enough? Creating a vision of retirement. More on that in a little bit. Very important. Evaluating your retirement savings. We'll talk about Social Security. We'll talk about Medicare. We'll talk about tax strategies. We'll talk about asset allocation. Where do you invest your money for retirement? What happens when you want to shift from growing that investment, that basket of eggs, if you will, to using it to produce an income stream? And then we'll also talk a little bit, if I didn't mention it already, about Social Security. So some of the questions that you had ahead of time, I want to just kind of address these quickly. So question number one, what is the best way to save for retirement if you're starting later in life? Start today. That is my answer to you. Start today. And for those of you that are looking at the volatility in the market and you're a little bit concerned about investing, I have a thought for you. Think about your favorite store in the whole wide world. It might be an art store, it might be a sporting goods store, it might be a clothing store, it might be a wine store. I don't know, whatever your favorite store is, wherever you like to go shop, whatever your hobbies and interests are. If I told you right now, everything at that store was 25% off, it's discounted 25%. My guess is you'd be figuring out a way to get to that store sooner rather than later to take advantage of the sale. Well, rather than being focused solely on the market volatility, put it all in perspective and remember that the market is 25% cheaper today than it was 6, 7, 8, 9 months ago. So if you're trying to save for retirement, as this person said they are, start today. Everything's on sale. What are the best strategies to save? Should I do a Roth? Should I do a traditional? What if I have to work 20 more years? Should I look at an annuity? So let me just address this. We're going to talk in more detail about this. I don't recommend annuities. I don't like annuities at all. I've only been doing this for 35 years. So I have more time ahead of me, and maybe I'll find a situation where the annuity was the best solution. But generally speaking, and again, we'll talk about this in more detail, annuities are expensive, they're not very tax efficient, and they limit your choices. So I don't recommend annuities. Whether you go Roth or traditional is a more complex question than I can answer right now because there are a lot of different details that I need to know about. But the most important thing is that you just do something, right? So whether you go Roth or whether you go traditional, do something. What else do we have? I really require basic skills to retirement. Where is this located? It is online. So hopefully you are here with us. That was Laura. She was curious about where it's going to be. We're going to touch on 403Bs. I know you're all familiar with that. If you happen to be somebody who has a 401k or just an IRA, they all operate pretty much the same way. We're going to talk about all of those types of things. For the person who said they just started with Johns Hopkins in March, start today. Don't wait. As soon as you're eligible, get going. There's another person who talked about having some pretty significant credit card debt, but yet wants to invest for retirement. My advice to you is look at the amount of the interest payment on that debt. If it's pretty substantial, like if it's credit card payment, so it's double digit, you'll want to pay that down before you're investing discretionary dollars. Low interest rate debt, like mortgages though, typically 2, 3, 4%. Those, again, I'm just giving you general information, not specific, because I don't know everything about you. But for those low interest rate debts that you might carry, again, like a HELOC, home equity line of credit, or a mortgage on your property, I wouldn't be in a rush to pay those down if they're low rate. But if you've got credit card debt of 10, 12, 14, 15, 16, heaven forbid, 18, 20%, you want to pay that down pretty quickly. What else we got here? We're almost done here. We'll talk a little bit about life insurance. I already commented on annuities. Trudy was asking about life insurance. I would just encourage everybody on this meeting today, remember, life insurance is not an investment. So if anybody's ever talking to you about how you should buy whole life or universal life, generally speaking, no. If you need life insurance to replace income in the event of death by term, insurance is not an investment. Anybody who talks to you about how investing in whole or universal life is a great way to invest for your future, no, I'm sorry, but they are selling you smoke and mirrors. That is just simply not true. That's why insurance products are not regulated by the financial authorities, because they're not investments. All right. We're almost done here. And then somebody had asked me about budgeting. So we do a little bit in budgeting, but we don't do a ton of work in like day-to-day budgeting. But I have 2 great resources that all of you can easily access. And I'm pretty sure that there's no cost to either of them. You can find them both on the Johns Hopkins Federal Credit Union website. One is called Green Path, and the other is called Money Map. So I do some budgeting work in our firm, but we're more on the investment side than we are on kind of the day-to-day budgeting. So if you're looking for day-to-day budgeting, go to the JHFCU website and look at Green Path and Money Map. I think you'll find those very, very helpful. So there are a lot of questions that retirees have, but these are the big 3. Will I have enough to live the lifestyle I want? When can I be less stressed out about taxes and financial issues? And will I ever achieve my long-term financial goals? I will tell you, running out of money and paying taxes are the 2 big things I hear retirees concerned about most of the time. By the way, just a quick mention, our website, bwfa.com, has a lot of resources at that website, including all of these webinars that I mentioned to you, the 184 webinars that I do. I record them and I post them on our website. So if you're looking for information, for example, on Social Security, I know we just did Social Security for the credit union, but maybe you couldn't attend that day. you can go to our website and access the recorded version along with many other topics. And again, just very, very briefly, for those of you that want to know a little bit more about us, as I mentioned, we're a fiduciary. We're in Columbia. If you're driving down Route 29 near the Columbia Mall and you're heading southbound, look over your right shoulder. That's the BWFA building. You'll see we're right next to Merriweather Concert Pavilion. And we work with people in a lot of different areas, not just investments, but also financial planning and taxes and business overs, estate planning, trust services. So we bring a lot to the table. Okay, here's one of the first nuggets that I want you to remember. And again, remember, you're going to get a copy of these slides. When you work with a financial professional, you have a choice. You can work with a broker. Many of you may also think of that as a stockbroker. That individual may be a wonderful human being and might do good work for you, but just know the way our industry works, they have no legal obligation to you whatsoever. They are not required to put your interests first. In fact, they are required to put their employer's interests first. Their clients come second. Conversely, if you work with a fiduciary advisor, they are required to put your interests first at all times. And that's what we are. We're a fiduciary advisor. So think about that just a little bit. All right, let's get into our conversation today about retirement. I want you to remember that retirement is not just about Social Security, your 403B, a pension if you happen to have one. It's not about all those nuts and bolts. Those are critically important, and you're going to need all those things, and you're going to know how to use them together. But retirement is about, hopefully, one of the most enjoyable chapters of your life. And so you should treat it as such and not just obsess about the financial aspect and logistical aspects of retirement, but spend some time thinking about what it is that you want to do. Because I can build you a financial plan that allows you to, spend the amount that you want to spend, never run out of money, deal with all the financial issues and make that less stressful. But if you're not doing what you want to do, if you're not retiring when you want to retire and living where you want to be and doing what you want to be doing and doing it with who you want to be retired with, then you're not really going to be very happy. So I point that out. All right, let's jump into avoiding the common mistakes, right? So it's really a wonderful thing when you can learn from other people's mistakes. And I got to tell you, in 35 years, I have seen some pretty incredible mistakes made. So since we have a lot of material, I'm going to move quickly. Some of these things, I just want to kind of get out there on the table. Again, you're going to get the slides. They don't require a whole lot of discussion. How much money do you need to retire? Well, that depends. How much money do you plan on spending? Let's just say, for argument's sake, I'm going to keep the numbers very round here. Let's just say you're going to spend $120,000 a year. That's $10,000 a month. So you want $120,000 a year to live on. Well, let's assume, for argument's sake, that you have a pension. And let's assume that between you and your partner, you and your spouse, your pension provides you with $40,000 a year of income. Let's also assume between the two of you that Social Security provides you with $40,000 a year of income. Well, now that tells me quick math. I got 40 from my pension and you got 40 from Social Security. That's $80,000. If you need 120 a year, then you need to produce $40,000 a year of income in order to supplement your pension and Social Security for that $10,000 a month that you need. Well, that tells me that you're going to need about $1 million of properly invested assets. When I say properly invested assets, that could mean different things for different people. But what it does mean is this: it's not $1 million in cash. It's not $1 million all in bonds. It's probably not $1 million all in stocks, but it might be. It's $1 million of diversified investments. All right. Not $1 million worth of CDs. CDs are not really an investment. All right. So when you think about how much you're going to need, there's a guideline for you. Another common problem that folks have is too much cash. And this is a huge problem right now. People have too much cash. Why? Well, they're nervous about the market. So instead of putting their money in the 403B or in other investments, they're actually putting it into cash. Well, it's great to have a nice pile of cash at the credit union, but that's not how you invest for retirement. So while I absolutely encourage you to have an emergency fund and a savings account and, a checking account and all that kind of liquid investments for you, have that in the credit union, your retirement dollars, those dollars that you're putting aside to afford to retire in 5, 10, 15, 20, 30, 35 years, whatever it might be, you don't want those in cash because that's not going to grow. That's not what cash is designed to do. Cash is not going to help you retire. It's going to help you live life safely as a tool to manage some of your money, but it's not how you want to invest to retire. And a way to explain that to you is by sharing the rule of 72. Hopefully some of you are familiar with the rule of 72. However, the rule of 72 may not be intimately familiar to all of you. So let me describe to you what it is. The rule of 72 tells me if I divide 72 by the rate of return that I am earning on my investments, that will give me approximately, but pretty darn close, the amount of time it will take for my money, my investment to double. So let's just make this super simple. Let's say R, or the rate of return on your investment, equals 7.2%. By the way, that's a fairly conservative rate of return. You should be able to easily, over longer periods of time, I know nobody's earning 7% right now in their investments. They're probably down 15 to 25%. That's okay. Won't last forever. You should be able to easily average 7.2%. So that's a very reasonable and conservative expectation on a well-diversified portfolio. So I divide 72 by 7.2. That tells me the time period is about 10 years. So if you're earning 7.2% on your money, it's going to double every 10 years. If you have a lot of money in cash, you can see at 1.5%, and you may not even be earning 1.5% on your cash, but let's just assume that you are. It's going to take you 48 years to double that money versus at the other end of the spectrum at 12%, which I realize is a little bit on the high side, but now you're doubling every 6 years. 6%, certainly very doable over any lengthy period of time, any 3, 5, 10, 15, 20-year period. You should be able to easily, you can do 6% standing on your head if history is any guide. Now you're doubling your money every 12 years. And as I said, 7.2% is pretty reasonable to assume as well. Every 10 years, you get the idea. So I see this all the time. People say, oh, I'm really nervous about the market. I'm going to put all my money in cash. Or people did this during the pandemic. They said, oh my gosh, look, the market's down 25%. I better move everything to cash. And then what happened in the second half of 2020? The market went screaming back up, not only recovered everything that it lost, but finished 2020 up well over 20%. Well, if you're one of those people that went to cash, you didn't get that upside. So you've got to be disciplined about your asset allocation, okay? Asset allocation represents 92% of your rate of return. So let me explain that. whether you own Microsoft, Amazon, or Apple stock versus Nvidia or Target or IBM or ExxonMobil or anybody, you name it, Black & Decker, Home Depot, whether you own any of those individual companies or whether your asset allocation is appropriate to your strategy and your risk tolerance, the asset allocation is going to drive 90% of your return. The security selection, 10% or even less. So stop obsessing about finding the next Apple or the next Microsoft and focus on making sure your asset allocation is in sync with your investment strategy and your risk tolerance. You'll be much better off in the long run. So again, we talked about approximately how much you would need, why you don't want to have too much cash, and why asset allocation is important. Now I want to take it one step further and talk a little bit about timing the market. Probably a lot of you, if you've ever been to a Sandy Horner BWFA webinar, you've heard me talk about this before. This is a huge bear trap, if you will. And that's actually, I just came up with that, but it's actually a pretty good term for it, right? Because bear market when the market's going down, bull market when the market's going up, and I call this a bear trap. So many people get caught in the bear trap of thinking that they can outsmart the market, that they know when the market is going to go down. And we call that trying to time the market. And basically what it means is people say, well, I'm going to take my money out of the market when it's going down, and I'm going to put my money in the market when it's going up. And I'm going to tell you right now, you are never going to be successful at that over any period of time. You might get lucky once, and you won't even get lucky twice. You'll get lucky on one of those. So in other words, you'll take your money out of the market or you'll put your money into the market at approximately the right time. But if you're a market timer, so if you're one of these people that you actually think you can do this on an ongoing basis, pull your money out in bad markets, put your money back in good markets, think about this for a second. So first of all, they don't ring a bell at the top and they don't ring a bell at the bottom, as we always say. Or in other words, remember, nobody knows where the market top is and the market bottom until after the fact. You're hearing a lot of talk right now about, are we in a recession or are we not in a recession? Well, I'm going to tell you, I think we're in a recession. I don't care what any politician's saying, we're in a recession. But that's my opinion. Regardless of that, we don't identify whether we're in a recession until after we've been in it for a period of time. Same way you don't identify whether you're in a bear market or a bull market until after the fact. So look at this chart for a second. You're looking at a 30-year cycle of time here. Had you invested $10,000 in the S&P 500, just let it go for 30 years, you never touched it, you have over $208,000. That's the first vertical blue bar on the left-hand side of the page. 208, 215, not bad. Moving left to right, if you miss just 10 of the best days in that 30-year time frame, your return is cut by 54%, and now your 10,000 is only worth 95,390. And you can see if you miss 20 days or 30 days, how the impact is even more horrific. I mean, think about that. 30 years, 30 of the best days, instead of earning 208,000, you earn 35, 36,000. That's a big, big difference. And if you're a market timer, chances are you miss those days. Now, for the person in the audience who I haven't yet made a believer out of this, let's look at the next slide. Same time period, but now we're simply looking at not the worst days, but the best days. And I'm breaking down the 50 best days for you so that you can see when they occur. Please remember, as I said a moment ago, We do not ring a bell at the top and we do not ring a bell at the bottom. And when I say we, I mean the financial services industry. So everything is hindsight. Kind of ironic for an industry that's built on forward-looking forecasts, right? Anyway, now we're looking at these 50 best days, same time period, and what do you see? Look at the yellow half of the pie. It's half of the best days. So 25 of the best days occur when? During the bear market. Reminder, bear market is when the market's going down. 28% occur during the first 2 months of the bull market. So in other words, 28%, okay, about a quarter of these 50 best days occur in the first 60 days of the bull market. Now remember, nobody knows exactly when the bull market starts. So you may not realize it for weeks or a month later. So now you're telling me that roughly 3/4 of the best days over a 30-year time frame are either happening in the bear market or right at the beginning of the good market, the bull market. And then another quarter, even less than 25%, occur during the rest of the bull market. So basically, folks, 78% of your best days occur when the market's bad. How do I explain that? Because the market moves over long periods of time, but most of the significant performance comes in very short bursts. And that's why it's so important to remain invested. Because if you're unlucky to be out when it sees a good run up, which might happen in a day or a handful of days, you're going to miss out on that. So don't try to time the market. You can see, as I said now, that next topic is annuities. So let's talk a little bit about annuities. This is a whole hour-long conversation in itself. I am showing you literally one slide of an hour-long discussion that I have about annuities. So I encourage you, sign up for the BWFA webinar on annuities if you want to have a live interaction with me and learn more about annuities, or you can go to our website, bwfa.com, and you can watch the recorded version that's on there. Quickly, here's the problem with annuities. As I mentioned a little bit earlier, they're very expensive, very expensive. Annuities typically range in expenses anywhere from 2 to 5%, okay? Annuities are also very problematic in terms of tying up your money. It can be very hard to get your money out of an annuity. With some annuities, once you annuitize, as they call it, and create that income stream, you can't get the money. It's not yours anymore. You don't own it. The insurance company does, and it's gone. You never get it back. And then what happens if you unluckily get hit by the crosstown bus? Do your beneficiaries get anything? In many cases, no, they don't get anything. The insurance company gets to keep the money. The other thing about annuities, I mentioned this earlier, they're not investments. So for any of you, I don't want to hear you say you're going to invest in an annuity, because you don't invest in an annuity. It's not an investment. It's an insurance product. So you can see here that I'm showing you 3 different types of annuities: the single premium annuity, the deferred income annuity, and the variable annuity. And then at the bottom of the page, I'm showing you what I would just call a taxable investment account. That's like you just knocked on my door one day and said, hey, I've got some money to invest. Can you open up an investment account for me? No, it's not an IRA. I already have one of those. No, obviously it's not a 401k or a 403b. You're not my employer. It's just, I got this money I want to invest it. Okay, we would call that a taxable investment account. And of all these 3 different annuities compared to the taxable investment account, you're better off in the taxable investment account. The only time an annuity is a possible solution is when you have years left to live, 10, 20, 30 years, and you have very limited financial resources. But I will tell you, literally, I had a gentleman come to me in the last year. He was in his 60s. he had less than $200,000 of investments. That's all he had. He had nothing else. And I ran the numbers for him and we did a comparison. One of the reason he came to me is he was talking to some broker at another firm who was trying to sell him an annuity. He brought that proposal to me and I ran a comparison of that versus just having a taxable investment account. And he was better off doing a taxable investment account. So just be really, really careful about annuities. They are not what most people think they are at the end of the day. All right. So we talked about how much you're going to need. We talked about too much cash. We talked about the importance of asset allocation. We talked about don't try to time the market. Friendly reminder, it's not on this slide, but we also talked about everything is on sale right now. Let's also talk about having an investment strategy. Okay. So this is not an investment strategy. Unfortunately, it's how a lot of people invest. A lot of people look at the market, they see it's going up, it's going up, it's going up, and they say, oh, wow, look at that. They talk to their coworkers, they talk to their neighbors, they hear everybody talking about how well they're doing in their 403B and their investments. I know you're not having these conversations this year, but think outside just the last 9 months. And this is how a lot of people do. They go home and they say to their loved one, they're like, oh, you know what? I talked to Joe, I talked to Sandy, I talked to Susie, I talked to, Martha. Oh, they're doing so well in their 403B, their IRA, their investments. We got to put some money in the market. They put money in the market at the top where it says greed. They buy up there. And then when the market goes down, and trust me, it will go down because it always goes down. That's what the market does. It goes up, it goes down. Do not be surprised at this, ladies and gentlemen. We know the market is going up and down. No surprises there. The good news is that it goes up a lot more than it goes down over longer periods of time. Like about 3 times out of 4, it's going to go up. 1 time out of 4, it's going to go down. And you just have to be patient and muddle through those down markets and take advantage of all the majority of time of the good markets. But about 75% of the time, the market's going up as compared to going down. Rough calculation there. So don't invest like this. Use your smarts, use your noggin, invest when the time is right, and invest in the right investments. And as I said, now may or may not be a great time for you, depending on all the other details of your personal life. But I will tell you this, if you have, certainly 10, maybe even 5, 15, 20, 25, 30 years to go before retirement, and you're asking me right now, hypothetically, is now a good time to invest for retirement? Yes, it is an awesome time to invest for retirement because you're going to see your investments bounce back at some point, just like it did after the pandemic correction down 25, 30%. You're going to see this correction bounce back. And then the market, if history is any guide, I don't have a crystal ball. I'm not promising you anything. This is no guarantee. But based on everything we've seen, at some point, the market's going to snap back. It's going to recoup the losses and it's going to start moving ahead. That's would be what we would expect to see. Often, investors are their own worst enemies. So the chart that you're looking at right now, the blue vertical bar is the average investor. The orange vertical bar is the market. And we're looking at just stock funds on this, okay? But as you can see, that blue bar is less than the orange bar in every time period. Significantly less. That's not good. Why does that happen? Because investors are their own worst enemies. They think they know when to get into the market, when to get out of the market. They think when a certain investment is not performing that they should sell it and maybe get into something else. many times this is not a good strategy. It might just be that the particular investment that you have is out of favor right now. It doesn't mean it's bad. It just means that it's out of favor. And as long as it's fundamentally still sound, there may be no reason to get out of it. But often investors think that they're doing the right thing by getting out of an investment when really they shouldn't. Anecdotally, I will tell you that, and I'm not going to get into a long diatribe about this because we don't have a ton of time today, but anecdotally, no, excuse me, let me rephrase that. Statistically, with data and research, it has been proven. Google it, you'll find it on the internet. I talk about it in some of my other webinars, that the smartphone has hurt investors more than it has helped investors. Why? Because it's easier for you to make bad decisions, and it's easier for you to execute those bad decisions because you can go right on your smartphone, hit a button, pull up that app on your 403b or wherever you're invested and make changes willy-nilly. And guess what? Some people actually do that, and it's not a good thing. It's hurting the performance of the average investor who uses a smartphone. So at the end of the day, how are you going to evaluate your retirement savings? Are you going to do it yourself? Or are you going to hire somebody like BWFA to evaluate it for you? Well, I don't know. Only you know the answer to that. So let me just remind you of one thing. For most of you, if you're getting closer to retirement, that is not a dress rehearsal. There is no second act. There is no back nine, whatever you like for your analogy. It's real life. And so when you are trying to determine if you have enough, make sure that you're not using linear analysis. I share this word of caution with you because a lot of people Google retirement calculator, and then you go online and you see one of these internet-based retirement calculators that says, oh yeah, we can tell you if you have enough or how much you got. No, that is not going to work. It's linear. If you are not familiar with that term linear, that's like a fixed rate calculation. That is assuming that you're going to have a constant rate of return. You're not going to have a constant rate of return. If we know anything, we know that about the market, right? In 2021, we were all up 20%. We're sure not up 20% this year. So you have to use randomized mathematics. For those of you that are in higher math, we refer to that as Monte Carlo simulations, but it's really important that you remember that. Also remember that if you do these calculations and you find that you cannot retire in the manner that you would like to, that's okay. As long as you're not retiring next week, next month, or maybe hopefully even this year. If you've got some time, you can start making some changes to that plan so that you can retire when and how you want. All right, so keep that in mind. All right, there are a lot of different ways for you to generate income in retirement. I want to share a couple of thoughts with you, and then I'm going to talk to you about 3 different ways that you can generate income in retirement: the bucket approach, the dividends and interest approach, and the 4% rule. What I want you to remember is that generating income in retirement is going to be a wholesale shift for you as compared to everything that you have been doing up until now. Let's put more clarity on that. So let's assume that you're preparing for retirement and you're thinking about how you're going to generate income, even if that may be 10, 15 years away. For 20, 30, 40 years, your career, you've been focused on growing your investments, right? It wasn't about income. It was, let's make that pile of money bigger. It was about growth. Now, all of a sudden, you are going to need to take that pile of money And instead of having your number one priority be about growing it, now your number one priority is about generating an income stream with it. How do you do that? And by the way, just side note, for many of you, it's not just about producing income, it's about continuing to grow that money, because you need to grow that pile to generate more money. So quickly, one way to do it is called the bucket approach. So in bucket number one, you have your cash, your short-term investments. This bucket number one could, in theory, literally have anywhere from 1 to 3 years worth of living expenses for you going into retirement, so that when you separate from service and you are fully retired and you need to start paying your bills with no earned income, you're ready for that. And you don't have to worry about whether the market is up 20% or down 20%, because you have your living expenses for 1 or 2 or 3 years, depending on other factors. Too many details to get into in this general discussion. But you have 1, 2, or 3 years set aside in a non-market correlated asset. If you did that, then in February of 2020, when you were getting ready to retire and the pandemic was sending the market into a tailspin, you didn't stop your plans. You had your living expenses out of the market. You didn't have to worry about that. And what did I tell you about 2020? Well, by the end of the year, the market was not only back to prior year levels, but up over 20%. So you actually made money in 2020. You got to have your living expenses in a non-market correlated bucket or tranche, or whatever you want to call it, vehicle. If you take this approach, the way you build it out is then you have a bucket number 2, which is for your slightly more aggressive investments, kind of your 6 to 15 year money, as we call it. You have that portfolio, which in general would be a conservative portfolio, but now this is invested in the market, and any dividends or interest that it's generating are spilling over back into bucket number 1. So as you spend that money down, you get more money back into it from the dividends and interest from bucket number 2. Same is true with bucket number 3, even your more aggressive investments, and those dividends and interest are replenishing bucket number 2. It's a self-fulfilling prophecy, if you will, here, of a way to manage your annual expenses. Dividends and interest are also another way that people will provide an income stream in retirement, right? So they'll just spend the dividends and the interest from their investments. And that's a viable way to do that. I need to have some concerns on this. So what if you have to go buy a new car? What if a family member has an emergency and you want to lend them some money? What if fill in the blank for your family? And you have to sell some investments. Well, now you just sold off some of your income stream, because if you sold some of those stocks that were paying dividends, now you're no longer getting dividends on that stock. If you sold off some bonds that were paying interest, now you're no longer getting the interest on those bonds. So you just need to be careful about that. They can absolutely work with you. We encourage you, if you use the dividends and interest approach, to do it as a complement to the bucket approach. And then the 4% drawdown rule is basically a process by which you are just drawing down 4% of your invested assets to produce an income stream for you. But again, you typically don't want to do this just when you need it. You want to manage it through that bucket approach, so that if the market is down, you're not having to sell stocks in a down market. Again, very, very important. I go back to what I said at the beginning of our time together. The most important thing about creating a retirement paycheck is that you don't do it when you need it. You do it ahead of time, so that you're ready for retirement when that time comes. All right. Couple more things here that I want to talk about, and we're going to take some more questions. I've got at least one question in the queue. I would remind you all that if you want to share a question with me today, you can type it right into the Q&A box there on the Zoom toolbar, and I will be more than happy to answer questions. I'm going to wrap up my prepared comments here in the next 5 minutes or so, and then we'll have a little bit of time for Q&A. So, another thing that you're going to want to think about is Social Security. Now, remember, there are some aspects of Social Security outside what I'm going to say right now, but generally speaking, you can take Social Security as early as 62, or you can take it at your full retirement age, which is probably 66 or 67 or some number in between those two ages, or you can wait and take it at age 70. Many of you may be aware that if you take it at 62 or younger-ish, rather than waiting till 70, that you get a lower payment, right? So you get actually a penalty if you take it before your full retirement age, which is 66 to 67. You get a penalty. That's a permanent penalty. You never get that back. But you will get Social Security for a longer period of time because you're going to start taking it before your full retirement age. If you take it at your full retirement age, again, that'll be some number between 66 and 67 or one of those numbers, then you get the full amount. If you wait till 70, you actually get an increased benefit. It grows by 8% every year after your full retirement age. So it could be anywhere from 24 to 32% higher than your full retirement age. And by the way, that enhanced or increased payout, that is permanent. You get that for the rest of your life. Generally speaking, if you're in good health and you're going to outlive Social Security's life expectancy tables, the benefit is greater if you can wait and take it at 70. But there are other factors. Your age, whether you're working or not, what's your health and longevity situation, other savings and investments do you have? Are you married? Are you not married? Do you have other tax liabilities that we need to know about? There's the 8% raise that I just alluded to. You might be qualified for spousal benefits. You might be entitled to survivor benefits. By the way, you might be entitled to divorcee benefits. 85% of the people entitled to survivor or divorcee benefits are not collecting their benefits. If your spouse has passed or you are divorced, you really should be looking into this because you may be entitled to benefits. We have BWFA, we have quite literally had somebody come up to us at a Johns Hopkins Federal Credit Union webinar just like this, where we were talking about Social Security. They shared a little bit of information with us. We told them what we thought they should do. They called us back before the end of the week and they said, you know what, you were right. I'm entitled to a benefit. I didn't know it. It's $25,000 a year and now I'm getting that benefit. Thank you very much. So be careful to make sure that you are applying for any benefits that you might be entitled to. All right, what else are you going to worry about in retirement? Health insurance. There are a lot of different options. You might get it from your employer. You might get it from your spouse or partner's group health plan. You might be on an individual plan of your own. You might be on Medicare. The point is, don't overpay, especially if you're on Medicare, right? Medicare, again, 70, 80, 90% of the people on Medicare overpay because they don't shop around. If you want to know more about that, go watch our Medicare webinar or sign up to see our Medicare webinar. I literally just did one yesterday on this very topic. It'll probably be, there's probably an older one on my website right now. This one will get posted on the website tomorrow. Brand new information on Medicare. Lots to know about retirement. One last thing before we move forward. IRAs are, not just for your upside anymore, but they're creating problems for people. Let me explain what I'm going to here. I'm a little tongue-tied. I've been talking for almost an hour. I apologize. I will add clarity to this discussion. Then we're going to go into questions. So let's say you retire with $500,000 in your 403B, or maybe you have $1 million in your 403B. You're in your 60s, you roll that over to an IRA when you retire, which is what most people want to do. By the way, there's no taxes due. There's typically no cost to do that. And now you have a little more flexibility and freedom when you roll it to an IRA because you have many more investment choices and things of that nature. In any event, you do that. Well, based on the rule of 72, how often is that money going to double? About every 10 years. So let's say you retired at 62, you rolled over your $1 million 403B account, you invested in your IRA, now you turn 72, you have $2 million. What else do you have? You have to take required minimum distributions. So you have to start taking roughly 3.5% of that account value out every year. You don't have to spend it, but you have to take it out. You can put it right back in another investment account, but you have to take it out. Why do you have to take it out? Because when you take that money out of your traditional IRA, it's going to be treated like ordinary income, and Uncle Sam wants their tax dollars. Now, if you put some of this money in a Roth IRA, you won't have to take required minimum distributions on your Roth IRA or your Roth 403B for that matter. But if you do only Roth, then you limit and you pay more taxes now. So again, complex subject. My point being, be thoughtful about how you're thinking about that. And one of the best ways that you can be thoughtful about Medicare, Social Security, your 403B, your IRA, required minimum distributions, knowing whether you have enough. Do you need more? Do you have too much life insurance? Do you not have enough life insurance? I could go on and on. The best way to know about all these questions is to have a financial plan. And if you want to know about having a financial plan, schedule a time to talk with me. It's super simple. You can go right to the website and you can go to bwfa.com. You can click on request a consultation, fill it in. You can have a discussion with me. We'll talk about your personal situation. We don't charge for that. You're not obligated to do anything, and you can get some more personal information. But my point is, you need to have a plan. And that plan is going to tell you in large part what your investment strategy should be. And the two of those things are going to dictate what your tax strategy should be to minimize your taxes. And then at some point, you're going to want to make sure that your estate planning documents, your legal documents are in order and that they're up to date, they're current, right? Do you have an advanced medical directive? Do you have a power of an attorney? All of these things. And if you're here today because you wanted to get some answers from a financial professional because you're doing this all on your own, great. I tip my cap to you. But I will also tell you, based on my experience of 35 years, at some point, you're going to need a trusted advisor. So start developing a relationship with that advisor, because when you're going to have a question, when you're going to have something that's outside your wheelhouse, is typically, based on my experience, not when you're going to want to go interview people to determine who is the right advisor for me. It's most often when you're undergoing a significantly stressful time in your life. It may be due to an employment situation. It may be a health situation. It may be a family situation. But again, I will tell you, only twice in my career has somebody come to me and said, "Hey, I just won the lottery. I need your help." Now that's kind of fun, but that's only twice. All the other times it's, "Hey, I lost my mom, I lost my dad, I lost my spouse, I lost my job, I have a financial concern, I have a health situation, and I need your help." And I think we can all agree that would not be the time you want to start interviewing financial advisors. You got enough going on. Just like you don't want to start interviewing roofing contractors when you have a hole in your roof. You want to know who to call before you get the hole in your roof. So we're going to go to Q&A now. I am going to stop the screen share because I think it will be more fun if we can see each other in a little bit more full screen mode than not. Debbie, I think I have till 1:15, but can you just confirm that for me? Okay, great. We have about 15 minutes to do Q&A.
You also have a chat. You have a couple chat questions.
Okay, cool. I will get through the chat, and we got about 5 in here. So 15 minutes is a good amount of time, but it's not a huge amount of time. So if you have an easy question for me to answer quickly, I'm going to answer it quickly, and I'm going to move on. So first question, I want to start an investment account for my granddaughter. Not a lot of money. I would like to speak to someone on this topic. All right, you can talk to me on that topic. I told you how to get in touch, but I'm going to tell you right now, if you're investing for your granddaughter, she has a lot of time ahead of her. I'm assuming 10, 20, 30, 40, if not 50 or 60 years. My quick advice to you is you want to look to stocks, not to bonds, because you're going to get a much greater rate of return. And your granddaughter is young. She doesn't need to minimize volatility right now. She can take volatility. She's young. Hopefully she's not going to spend this money for a long time. Now, if you're telling me she's like 12 years old and you're investing for her to buy a car in 3 to 5 years, okay, that's a whole different conversation. All right. And if you have a little bit, you didn't quantify what a little bit of money was, you don't have to either. But I mean, if you're looking at, $5,000 or $10,000 or less, you're probably going to want to invest through like a company like a Vanguard or a Fidelity or a T. Rowe Price here locally, where you can invest a small amount of money. So that would be my quick advice. Call me if you want more. Is it wise to sell an annuity to reinvest in index funds or the stock market? I'm sure there are many factors that play into this decision, but are there general rules? After 59, there might be fewer penalties. So yes and no. Lots of factors, as you suggested, Lori, play into this. Here's what I'm going to suggest to you. Rather than me shooting from the hip and giving you some advice that could be way off base, let me again share with you an idea of how you could determine the best way to address this situation. I work with a company that does an independent evaluation of annuity contracts, and that's what they're called, annuity contracts. It's not annuity investment. And you talked about reinvesting. Remember, your money's not invested now. I'm kind of pulling your leg, but you get the idea. I am more than happy to do an analysis for you, no cost, no obligation on your part. All I would need you to do is to share the annuity statement that you have, a relatively recent one. I will have a full analysis done for you, and then I will get together for a virtual meeting if that's convenient for you. I will send you a copy of the analysis so you'll have it, and we can talk about what it shows and what your best options are. So that's what I would share with you if you want to get out of an annuity. And you can see to the audience, here's somebody who's already figured out they have an annuity and they're thinking about getting out of it. Please, please, please be careful with annuities. Can you get Medicare, Medicaid if you don't take out Social Security, retirement? So yeah, you can. So Medicaid's a different deal. Medicare, I think, is what you're really talking about. You want to apply for that, about this time, age 65. So just go ahead and do that. Don't worry about if you haven't started Social Security or even if you're not retired yet. That's not an issue that you need to be concerned with. How do you know if you qualify for survivor benefits if Social Security was stopped? So there are some, things that obviously you had to be married for 10 years. You have to not be remarried. There's a few other, caveats. But again, give us a call, or you can just go Google it on the Social Security website. It's pretty easy to find it. But again, I'd be happy to answer your questions. Again, it's the thing, I hesitate to go into these kinds of details in this group audience because I might say something to you that may or may not be applicable for you. There's a whole bunch of things I don't know about yet. but it might not be appropriate for somebody else. So I try not to get into a lot of detail. I live in New Jersey. Would BWFA located in Maryland be able to help me? Or should I find a fiduciary advisor in New Jersey? So first of all, I love the fact that you included, should I find a fiduciary advisor? Yes, absolutely, you should find a fiduciary advisor. However, I will tell you that BWFA today has clients in 45 states and 11 different countries, literally all over the world, all over planet Earth. And if you would like to work with us, we have clients in New Jersey. We can do everything we do for you virtually and electronically. And from time to time, we jump in the car and we come up to New Jersey, and we'd be happy to meet with you when we do that. So let us know again if you need help on getting in touch with us. And I'm going to share this with Debbie. So two things. Number one, Debbie, I know you're going to send out the slides today to the audience. If you want to send them out, my email address in that email, when you send that out en masse, that is okay with me. Short of that, you can always go to the BWFA website, bwfa.com, and you'll see there's a button at the top of the website to request a consultation. You can always do that, and then we can have a conversation. And it doesn't have to be a meeting here at my office. It doesn't have to even be a virtual meeting. It can just be a phone call for 10 or 15 minutes if you want. If married, would both partners need to be there for a consultation? It's beneficial to have both of you here, but it's not required. No, absolutely not. And again, folks, we're not trying to make this difficult. At BWFA, we try to make this super simple. If you don't know if a relationship with a company like mine would be right for you, schedule a 10 to 15 minute phone call with me, with or without your partner or your spouse. And let's just talk about it for 5, 10, 15 minutes. And we'll see what some of the details are. And if it's a good fit, we can talk more about how that might work and maybe what the next steps would be. And if it's not a good fit, I'm going to give you guidance on what would be appropriate for you. And there's a lot of times, well, not a lot. There's some times when I talk to people and they're not the right fit. Not everybody's the right fit to work with a financial advisor, or maybe you're not at the right point in time for you to work with a financial advisor. I promise you, it doesn't mean I'm going to say, see you later, goodbye, click. It means I'm going to say, okay, so probably working with us right now is not the right match for you. Here's what I would recommend. Why don't you do this? And I'll give you advice on what you should do. All right. On the details, enter. Okay. I don't think that's a question for me. So I'm going to pass on that one. Oh, yes, I did. Did get that. All right. So those are all the questions I have in the Q&A tab, but now I'm told there's some questions in the chat box. So I'm going to go look through those. So if anybody has more questions, we've got about 9 minutes left. Try to send it in through the Q&A box. It's just a little easier for me to track it there. Are your services only free for Hopkins employees? Well, let me be clear that not all of my services are free. The consultation is free. Some of the things that I offer, like annuity analysis or investment analysis, those are free. For Hopkins folks, there are some discounts on our paid services. But again, if you want to schedule some time to chat with me, we can talk a little bit more about that. How do you determine who is actually a trusted advisor? What is a reasonable time to work with somebody to determine if that's a good fit? Great question. So I really like the fact that you brought into this question the aspect of having a period of time in which to make the judgment. So to the first point, how do you tell if somebody is a trusted advisor? Make sure they're a fiduciary, and make sure they're a fiduciary all the time. When you get the slides, go look at that slide that I had on fiduciary versus suitability standards, and you'll see some language there. Advisors can be fiduciaries, but I hate to tell you, they can also be brokers. We're not like that. we're a fiduciary 100% of the time. Make sure you affiliate with somebody who is a fiduciary 100% of the time. So that's how you find a trusted advisor. And then on terms of the timeline, I would say that you want to give somebody 3 years. Now, clearly, if it becomes obvious to you that they are just really doing a bad job in the first year, maybe you need to move on. But if you're just looking at the performance of your investments, you really should give any investment advisor who's managing your investments 3 years before you give them the boot. And the reason for that is judging anybody on a 1-year number is not really fair. And you really need 3 years for a full market cycle. So that's why I recommend 3 years. Take into consideration this. What if you hired a new financial advisor in January of 2022? There's almost a certainty that your account would be down 10 to 20% at this point in the year because the market's off 20%. Now, would you fire the advisor because they're down? Well, no, the market is down. But how are you going to know if the advisor can do a good job for you? You need to give him or her some more time. So that's what I would say about that. Let's see here. What else? What is your advice for how much cash on hand is recommended? Is a percentage of income or so many months of current expenses? So this is a question, thank you, Carol, that we get a lot. And that question is, how much cash should I have? How big should my emergency fund be? And a lot of people say, oh, 3 to 6 months. Well, that may or may not be right. When we build our clients a financial plan like the one I referenced earlier, we use a lot of inputs, a lot of factors for determining the right amount. So I would much rather have a conversation with you about that than just give you a general rule of thumb. But here's what I will say. You should have enough cash to handle not only your living expenses, but you should have enough cash for those emergencies. But you shouldn't have more than that for all the reasons that we talked about earlier. Carol, and I don't know if it's the same Carol, I didn't look at the names, forgive me, also got a questions about, and I have 2 more questions after this, just to let you know. So I think we have time to get all the questions, and we may even have time for another question if anybody wants to drop it in there. Carol asked me about I-bonds, nothing specific. She just said, what about I-bonds? So, what I'm going to tell you on I-bonds, read the fine print. They're not everything they're cracked up to be. I would go to my website, bwfa.com. My colleague, Larry Post, just recently did a podcast on I-bonds. I encourage you to listen to that. Again, for the sake of time, I'm going to do that. Listen, before you buy any, just listen to that. And you may think twice about whether I-bonds are really what you want. Can I work with you and have you as my advisor? Is a question from, I'm assuming your first name is Seema. Thank you for the question. So we don't work with individuals here. And what I mean by that is when you work with BWFA, you have multiple people on your team. And yes, I will be one of the people on your team. But you won't just get me, you'll get other members of my team. But that's what you want. Because guess what? I have CPAs here. I have certified financial planners. And I know a lot about investing and planning and taxes, but I'm not a CPA. So you want my accountants working on your tax issues. You don't want me. So you get the team. Does a fiduciary advisory actually have access to accounts, or do they tell the client what to do with their accounts? Great question. So typically when we work with clients, and I say typically because there's some flexibility with this, but typically when we work with clients, they don't want to go in and do what we tell them to do. They just want us to do it and then it's done. So that's how we set that up. Now, we can't take any money out of your account. We can't wire any of your money to our account. If that's why you're asking, if you're concerned about any hanky-panky, if you will. We manage your account. We can't get any money in. We can't get any money out. Usually when we work with our clients, we set up at the very beginning of our relationship a situation where we can wire money to our client's account, for example, at the credit union. So then if our clients say to us, hey, I'm going to buy a car this weekend, or I'm going to take a trip, I need some extra money, can you send me some money from my account? We can do that. But the only place we can send that money is to your account at the credit union or wherever your account may be. Conversely, you may say, hey, I have a little extra cash in my account and I'd like to invest it. And then we can move it there. But no, when we manage accounts, investment accounts for our clients, typically we are making those changes in their investment account. So if we want them to own some more Apple stock, we're go ahead and we're doing that. If we want them to sell Apple stock, we're going ahead and we're doing that, or an exchange traded fund or a mutual fund, so on and so forth. So, wow, we got through a lot in a jam-packed hour and 13 minutes, and I'm not going to push it. I think we'll start to wrap it up unless anyone wants to drop a quick question on me. We got 120 seconds left. Couple of friendly reminders. Again, you're going to get a copy of these slides, so look at them. I really appreciate that you came to the presentation today, and I give you a proverbial pat on the back, if you will. Awesome that you came. But do me a favor, go the next step. Do something with this information, whether you go on your own or you're one of the people who asked a question about working with BWFA and you might be interested in having a conversation with me, or maybe you're going to go talk to some other financial advisor. I hope for those of you that want to work with an advisor, you'll at least consider having a conversation with me. But whatever you do, whether it's on your own or whether you go talk to somebody, do something with the information. It doesn't serve you any purpose if you don't do something with the information. You'll get the slides, go to bwfa.com, look at the email for more information. I'm glad, this is a great webinar in all caps. Nora Lee, thank you so much. I really appreciate that positive reinforcement. And I really thank all of you for joining us today. I'm going to turn this back to Debbie in case she has any closing comments, and I'll stay on here in case anybody needs anything from me, or I can just end the conversation.
No, thank you, Sandy. This was awesome. And I will be sending out the slides. Now, the recording is actually going to be on our website, I would say the beginning of next week, but I will send a link out to where it's going to be housed. So just give me a day or so to send out the slides and your information, and we'll be good to go.
So Debbie, I may have misspoke on that. So I'm great. So you're going to post this recording on the JHFCU website shortly?
That's going to be probably next week.
Okay,
but I'm going to be sending out the slides. I'm not going to be including the recording at that time.
Okay,
but
cool.
The link to where it's going to be when we're able to include that.
Perfect. So everybody, you can see the recorded version of this webinar right on the JHFCU website. And if you want to see any other webinars, again, you can look on bwfa.com. There are literally hundreds for you to look at there. So great. Thank you.
Thank you very much. Now, everyone have a wonderful day.
Yes, absolutely. Stay safe. Stay healthy. Good to see you. Thank you. Bye-bye.
Thank you.